and one.
Hi, everyone. Dale Pinkert here at TradeGate Hub, sponsored by TradeView Markets. I have the pleasure of being joined today by Art Hogan. Art is someone that I followed on the major financial media for quite some time. Welcome, Art, to our community. And you know what, Art? I knew you before you had one gray hair on your head.
Well, then you've known me for a long time. I always tell my kids that I didn't have gray hair until they became teenagers.
Okay, well, I know that, the markets can do that to you too, especially this year. And, you and I have lived through many different cycles, going back to, I remember watching you in the 80s. Okay. So, we've been around for a while and, experience matters, especially when you have unprecedented things happening in the market. So I know you're the chief market strategist at B. Riley Wealth Management, and wonder what your view is after Moses came down from the mountain, that mountain being Jackson Hole last Friday, and laid down the commandment that prices must go lower. Do you think that we're in for bear markets? The big question that most people are asking, Art, is this recent pullback after this June rally that we've had here. Is this just a correction of this rally, this recovery, or is it, in your view, the resumption of a bear market?
Yeah, that's such a great question. I really think that there is two schools of thought here, right? And two camps that are really battling in markets right now. And I think one camp sits in a place that says the only reason we had that July rally off the June lows was because the after the July Fed meeting, the markets picked up on a more dovish Jay Powell and perhaps thought that they would raise rates this year only to cut rates next year. And
Okay.
if that's the place that you sit, then obviously you're going to look at this drawdown as the beginning or the resumption of a bear market that we entered a long time ago, right? So
Yeah.
that's one way to look at it. The way I would say is the other side of that argument is I would say that there's a credible possibility, and I sort of sit in this place, that the first half of this year certainly had a significant drawdown into those June lows, and that was, I think, predicated on three things. I think it was a fear of a second quarter earnings apocalypse that never came to bear.
Right.
A concern that the economic data was never going to get better on a sequential basis, and that certainly has seemed to have happened, and a fear that the earnings estimates post the earnings reporting season were going to collapse, and that really hasn't happened. And we entered the month of July, or at least hit the June lows and pretty significant oversold, right? Whether you look at RSIs or
Historic.
Yeah, they're very, very oversold. So the July bounce, you could make an argument that July bounce was technical because we're very oversold. You could make an argument that perhaps there was a narrative floating around that the Fed was going to get to 3.25, 3.5 in the Fed funds rate, and then next year have to cut rates. But the interesting part about all of that to me is that if you look at the Fed funds futures and what they had predicted coming into Jackson Hole and coming out of it, that hasn't moved a whole lot. Whether or not the Fed goes 75 or 50 basis points in September, I think is meaningless because it's where we stop, right? It's, do we end this year between 3.25 and 3.5? And do we eventually get to 3.75 and 4? And that remains intact. That consensus remains intact. So I don't know that it was Jay Powell doing anything more than trying to remove that narrative out there that, hey, we're not cutting rates. We're going to stick to this. And the reason that he invoked Paul Volcker 3 times in his very short speech was to point out the fact that there were mistakes made back in the late 70s and early 80s. And that mistake was to see some modicum of improvement in inflation and then start backing off. And I don't think that that's going to be something this Fed does. So I think the message is clear now. The Fed not only sees inflation as job one, but they're going to make sure they see significant improvement in inflation before they get their foot off the brake. And I think perhaps that's come to us as a surprise since last Friday. I don't think it should, and it certainly hasn't changed much in the Fed funds market.
Okay, so when you talk about the 70s, you're talking about Burns, but even who he's emulating, Paul Volcker,
right,
had to go twice, and the second time much more draconian, 20% T-bill rates. I was around, traded under Volcker. I think you were around during that regime as well. So with this being his stance that he's going to attempt to be like Volcker, the conditions and the structure of debt is so much different now than it was in the early 80s. There's no way that we would be able to service even the interest on the debt if we got to those kind of levels. And, maybe it was unrealistic for the market to start pricing in cuts next year. But a pivot to me is not going from tightening to cutting. It's going from tightening to standing
Right.
and resting. And doesn't it take at least 6 months for Fed policy in most instances to filter through to the economy anyway?
Yeah, I don't know if you're going to like this or not, but I couldn't agree more with all of the points you just made. So first, starting back with the Arthur Burns, who was more politically motivated and made mistakes, right? And it took a Paul Volcker to come in. But I think it's important for both of us to remind people the battle that Paul Volcker was fighting, right? So they had well embedded inflation and inflation expectations that had been there for 10 to 12 years, right? So inflation
Right.
expectations were actually causing some of the issues, right? If you thought things were going to be more expensive next year, it would affect your behavior both at the household and corporate level. It's also important to remember Paul Volcker was fighting 14% inflation with a 20% Fed funds rate. And the only time we found out about what the Fed did, and oftentimes they'd raise by 2.5% at a meeting, was to listen to what Manny Hanny and Chase Bank did the next day with the prime rate, right? We didn't have a press conference. We didn't have
Right.
we didn't have transparency. So the battle, while invoking what Paul Volcker had to do, is so dissimilar in nature to what we're fighting now. Obviously, an 8.5% CPI and PPI and a PCE that sits, just shy of 4.6%. Clearly an order of magnitude is different. So, what's the terminal rate that the Fed likely gets to is has to be at or about 4%. And at the very same time, we're seeing some of the inflation inputs roll over. But I think the most important point that you brought up is, what is a pivot? And I agree with you. A pivot is, okay, we're not tightening. We think we've gotten to a restrictive level that will be appropriate to bring down inflation. And how long do we have to stay here to see significant improvement? I think one of the key difficulties the Fed's going to have to do this go round, as they likely push the economy into a recession, is what parts of that inflation structure are actually structural and sticky, and what parts are actually going to come down on their own. So we've obviously seen commodity prices recede on their own, across the complex, whether it's the industrial metals for sure, copper's rolled over significantly, lumber, all of the industrial inputs. We've seen, to a certain extent, some of the ag complexes rolling over, but what's difficult to see roll over quite as quickly is wages, right? That's more sticky.
Yeah.
And certainly the housing component, or the homeowner's equivalent rent. And that's going to be sticky for a while, but we're starting to see that roll over as well. So to me, I think that, while, invoking Paul Volcker makes sense in terms of, being serious about fighting inflation, comparing, what Volcker had to battle, as you and I remember, sort of whipping inflation now and
Yes.
and
Great,
waiting in
Bob.
lines for gasoline,
Yeah.
versus what we're battling now, which is sort of a, once in a century pandemic, and how supply chains react to that, and how things sort of reorganize on the other side of this. And so, I agree with you. A pivot's going to mean we've reached terminal rates, and that likely happens in the first quarter or the beginning of the second quarter next year. That likely looks something like a Fed funds rate of 3.75% to 4%. I'm not sure, Dale, why they continue to have a range. Once you get above 1%, I think you can say the Fed funds rate is what it is, and call it 3 7/8 or 4%. But I think it's the length of time they have to stay there until they say, okay, you know what, we're starting to see some success here, and that may be well into 24, right? And let's say we get inflation down to 4%, and the Fed funds rate is at 4%. That gets back to, that's restrictive, but closer to neutral. They'll stay there until they get they see inflation heading closer to 2%. And I think they're going to be happy with anything below 4%, call it 3.5% before they say, okay, we're going to back down a little bit. But, that may not be until the end of 23's business, and maybe well into 24. So expect a Fed funds rate that's at or about 4%, and inflation working its way towards 2% as a target. But that target is unrealistic in the next 12 to 18 months.
I once asked somebody, do you think the Fed is making a policy error? And he said they always make policy errors.
Yeah.
So, we're talking about something that really has been the wrecking ball. Not, it's really been our advantage. It's been the strong dollar here, Art.
Yeah.
And strong dollar makes it inflation a little more tame for us here in the U.S., but it's really putting pressure on the rest of the world that are short dollars. And I'm wondering, if there could possibly be, maybe there's not enough cooperation, something like a plaza agreement that we had a long time ago to bring down the dollar. Perhaps the Fed might even welcome a weaker dollar because that would perhaps lift nominal values in equities, but give them cover for continuing to tighten. Do you think that the Fed sees the dollar as a problem at all, or it's a friend?
Well, right now it's a friend, right? In the short term, it's certainly a friend. Most commodities are dollar denominated, so stronger dollar is going to draw down those notional values for sure.
Okay.
It's an enemy to corporate America, where half of the S&P does more than half of their business in places outside the United States. So they're manufacturing things in dollars and selling them in other currencies. So that currency translation obviously cuts in, and we saw that pretty consistently through the second quarter earnings reporting season as one of the headwinds, right? And that's gotten worse, not better. To your point, a coordinated effort, it would not be something brand new, but it certainly be something new as of late. But remember, we certainly have seen some cooperation when we get into difficult periods of time. But remember, back in the financial crisis, and certainly back in 2020, the global central bank coordination was something that actually sped the process of recovery in both of those instances. And this may well be that point in time where we need to start working together, because the strong dollar at the end of the day, while a friend, in the short and medium term to the Fed, is going to be a detriment to the rest of the markets. And we need to do business with the, emerging markets as much as everyone else does.
Yeah, they're calling this strength a wrecking ball. And if something breaks in Europe, who are they going to turn to anyway?
Right.
Is the
Right.
Fed going to let Italian banks go down? They seem to be the lender of last resort in more than domestic issues or problems here in the U.S. So I'm sure they're also thinking about what's happening in China. China, and I want to ask you about this. Back in '08 during the housing crisis, one of the narratives was that China wasn't affected by that derivative implosion, and they were still growing. And they were the engine of growth that helped pull us out of that recession, the Great Recession, which I don't know if it was great for you. It wasn't so great for me. But if China could pull us out of recession, can China be a major contributor to taking us into one with what's happening there?
Such an interesting point, Dale, and everything you said is correct, right? So China being unaffected by the causes of the Great Recession, too much leverage, overdevelopment in the housing industry, too much speculation. I would argue that the removal of Glass-Steagall, having commercial banks getting into investment banking activity, and then the creation of a whole plethora of fancy derivative products that was meeting the demand that was there, mortgage collateralized loan obligations, etc. So China avoiding that and continuing to grow certainly helped, being the second largest economy, sort of act as the pull. Now the flip side of that is how much can China actually control their economic growth? And we've obviously seen two different things, and they're diametrically opposed with China right now. One is that they're aggressively stimulating their economy. They've got a target of 4.5 to 5% GDP growth rates, juxtaposed against a zero COVID policy that continues to shut down provinces and cities that measure
They
themselves.
can't reopen.
They can't. They just can't get there, right? And it's their lack of accepting the fact that it's got to be a combination of things, not just locking down. It was interesting at the very beginning of COVID, which started in China. They were back up and going in 3 months, right? And it was like, oh, that should be the template for the world. And then we realized, oh, wait a minute, that's not actually working. And they've had these rolling lockdowns for the better part of 2 years. They just can't get reopened. And no matter how much they try to stimulate with both fiscal and monetary policy in a controlled economy, unless and until they get to a place where they say this isn't working, a complete lockdown is not working, we have to lean in the direction of the rest of the developed world that says, you gradually reopen by doing it. and removing some of the sort of zero tolerance for COVID policies that have just hindered their economic growth. Now, if they don't do that, I would agree with you. If they continue along with the policies they've had, it's going to be impossible for them to not be dragging the rest of the global economy down, right? We saw that in the beginning of their lockdowns this year. One of the reasons that some of the commodity prices have come down so significantly is we lost China demand across the board, and we need China demand for goods and services globally to certainly, help us get out of the current recession that we're going to be in. So I couldn't agree with you more. And the only way out of it is for them to reconsider their COVID policies, and I'm not sure if that's on the short-term horizon.
Yeah, plus we have all these geo events happening in the background, which in the 70s it was Vietnam, but it wasn't a land war in Russia,
Right.
and the possible hostilities with China wanting to reunify with Taiwan
Right.
and all of that. Are you worried about some of this geo background, tragedies that are happening in Europe, and how the Europeans are going to get through the winter? I think that Putin has proved that Russia is more than just a gas station, which is
Yeah.
what a lot of people used to call them.
Right. Right. They're also, both Russia and Ukraine are the breadbasket for the rest of Europe, right? So,
Yeah,
and losing both of those things obviously has detrimental effects, right? So, away from the tragedy that any war is, the economic effect clearly is being felt, and it's going to be felt much on a much larger basis in Europe, right? So, they could have a disastrous winter if Putin continues to put a crimp on the outflow of the energy product that they need, and
have you
clearly
seen their electricity bills, Art?
it is
They've
yeah,
gone up tenfold for
it is
many people.
absolutely insane, and they don't have something to fall back on, right? So they sort of making a shift into new and cleaner energy sources too rapidly, becoming too dependent on hydrocarbons from an unfriendly provider, certainly has proven to be a mistake, right? And clearly, it's you'd be hard pressed in the short term to say how would they get out of this. Years
Yeah.
down the road, we could say the U.S. production of LNG is certainly going to be the savior for the whole world, to not have to deal with unfriendly providers of hydrocarbons, but that's just not something we can flip a switch on. We're working on that as quickly as we can, but in the near term, it's going to be a very, very tough human and economic winter for Europe, which was struggling to begin with. They were,
Yeah.
they certainly have demographic issues for sure, and clearly it's difficult to have one monetary policy and 19 fiscal policies and expect to have positive results. So the only positive thing for you and I, Dale, is that if we decide that we'd like to take a European vacation, our dollar's going to go a whole lot further.
Yeah, I heard Kramer say he's going to buy some suits. So,
Yeah.
I want to talk about, let's get to the markets now. That's what most people are interested in, making money. It's everything, right? Although I say money comes and goes, time is gone forever. Make it count. And I want to talk about Apple. So, Apple is what, 7% of the market cap of the S&Ps? 7,
About seven and a
8%?
half, yeah.
Okay, so the action that we had last week, it gapped down, and then before Powell couldn't fill the gap. And it's my contention that if we're going to have a turn back up in the market, that Apple has to dig in its heels above 150
Right.
for that to happen. It was a leader. It was very close to making new all-time highs, wasn't that far away. With China problems and everything, is this a break to buy in Apple? And do you look at relative strength like Apple demonstrating it compared to, a lot of the stars that lost 70-80% of their value before the June bounce? That didn't happen to Apple. What do you think here?
Yeah, you bring up a really, really good point here, and I think the last part of your point is really important. So if you're going to be an investor and you want to invest in growth, right? I think the best way to do that is growth that can be measured in a price to earnings, which Apple clearly is in that camp, versus some of those disruptors that were pandemic darlings that have seen 70-80% drawdowns. I don't
Yeah,
think looking at those is the appropriate way to sort of look at your portfolio as you move forward over the next 1 or 2 years. Apple falls into the perfect category. I would argue that so does Alphabet and Microsoft. So
okay.
in that sense, when we look at Apple, it feels like Apple has transitioned in a couple of different ways, right? So, 5 years ago, you and I would talk about Apple, and they would be largely dependent on their next release of a new gadget, whether it's the
Right.
iPhone 13 or iPhone 14 or 5G, et cetera, and what that means. But such a large percentage of their revenues now is repeatable because of their services business, right? And people that sort of get locked into the Apple universe, it's like the Hotel California, you just don't get out.
Right.
So it's the recurring revenue stream is much larger. And I think that Apple in and of itself also feels like a place where investors, professional and an individual, feel like it's the safest place to hide. It's almost become a defensive technology stock or a defensive growth stock. And it now, with the recent drawdown, I would argue that it's trading cheap to itself historically on a multiple, and probably with one of the most shareholder friendly management teams in terms of buybacks. Clearly the largest corporate to have buybacks over the last 5 years, dividends, and reinvesting capital to reinvent themselves every day. So I think that, if you see Apple touching that, so call it 150 or wherever the 200-day moving average is, looks like it's right at or about that,
Yeah.
and it holds. I think that a clear signal. It's on our focus list, and it's in full disclosure, it's something that I and my family have owned for a long time. We love it on our focus list. It's one of our top picks, and
Okay.
clearly see this as an opportunity, and would throw into that mix in terms of defensive growth stocks, Apple, Alphabet, and Microsoft. And when we say that, we mean by that is if the end of 2022 and into 23, you really want to focus on things that you need versus things that you want. Apple has turned into one of those things, and I would argue Microsoft and Alphabet are the same.
Okay. Thank you for sharing that. I know that you really, it's tougher you get stock specific in these interviews. I want to turn to something that, for the first time I saw in a long time, is that the bonds really led the decline in equities. They topped, I'll use TLT as a proxy, quite some time ago, and led top before the market, led it to the downside. Even when we were selling off, there was no flight to quality. That seems to be happening again, with the market sell-off. But on a shorter term basis, I think that TLT is starting to look constructive in my view. And I think part of what Paul is doing by tightening and having an inverted yield curve is to save the bond market.
Right.
So, do you have a view on bonds? I think if we could penetrate this level at the recent high, we could be looking at, 130 TLT, 135. And wouldn't that be constructive? This is what impressed me. The weekly candle that we had last week after Paul, talked like a super hawk, that the bond still closed good on the week. And this was a major breakdown in TLT up here.
Yeah.
So if this does manifest, just like bonds went down with stocks, could a bond market rally be the impetus for some type of melt up in the stock market?
Yeah, you know what? Again, as much as I hate to do this, Dale, I do agree with you that. And that was,
Stop it, Art.
I know we're supposed to be arguing here today, aren't we?
No,
So
it's
that,
okay. It's I can go either way. I prefer just to share my ideas and see what you think. But
yeah.
do you think there is hope for the bond
I
market here?
do, and I think what's the most notable is, and you brought this up, and this is something I highlighted over the weekend and at the beginning of this week. I think that the equity market had an overreaction to what Powell said for sure, right? And if he was just shifting the narrative to a place where he was removing the concept of the Fed thinking about easing rates come 2023, right? That's fine, and that was within consensus in the Fed funds. But if you look at the reaction and compare that to the reaction in the bond market, we hit on the 10-year. We picked up less than 2 basis points on Friday in a market that was down 1,000 Dow points. On the 2-year, we picked up 4.5 basis points, which makes sense because the 2-year really reflects our perception of where fund Fed funds are going to be in the short run. So if you look at consensus for the end of the year and look at the yield on the 2-year, they are in lockstep. And if you look at the 10-year, which is more a prediction of global economic activity combined with inflation over the longer term, that's exactly where it should be too. So it's inverted to your point for a reason. And I think that, you know, we're going to stay within a range of 2 3/4, 3 1/4 on the 10-year. And I think that, you know, throughout the balance of this year, and I think that's going to attract risk capital back to the market. As long as we don't have that explosive, like we saw at the beginning of the year in the second quarter, where we, you know, we're adding 15 basis points a week and people try to get to a linear place in an exponential fashion and say, okay, wait a minute, if we went from 3 to 3 1/4, we must be going to 4%. And as soon as that calms down and we stay within that range of acceptable risk on appetite driven yields at 2 3/4 and 3 1/4, then I think equity investors feel more comfortable. So to your point, I think that drives people back in the equity market saying, hey, this thing hasn't lost its mind. And we're seeing significant resistance at the 3.1 level on the 10-year. To your point, I look at the TLT a little bit less, but I think it's the exact same. I think we could draw the exact same lines. And I think that you have a really good point here. And it's interesting when we get to the lower end of that range, the more there is a capacity for investors to say, you know, let's get back into growth. And the higher end of that range tends to put people in more defensive sectors. And clearly, I think that's a healthy thing. But I certainly was much more impressed by the lack of movement in the yield markets post Jackson Hole and Jay Powell than we saw or have seen in a really low volume, low liquidity, volatility end of summer, August. And you know, I can't imagine what the reaction would have been if we pushed this Jackson Hole meeting off by one more week, because I think it would have been
thinner now.
Yeah, it just feels like there's not enough players on the field. There's not enough liquidity. The volumes, the overall volumes for the last 3 weeks are in a race to see who can be the lowest volume week for the year, right? And that's natural, and especially in a summertime where it finally feels like people that do this for a living, like you and I, are taking that revenge vacation because we haven't been out and about in a couple of years. So you know, if I was keeping track of my out of office replies to my morning note, I think we set a record. I thought we set a record last week. I think we're going to set a record this week.
Okay, well, the adults should be back from the Hamptons next week, and we should have some more volume coming into the market. And Art, you know, you're a perfect example of what I say is that you can't learn experience. It only happens with the passing of time and living through adversity and sticking with it. And if that scares you, do something else. And really appreciate you sharing your pearls with us today, Art. It's an honor for me to be able to have a conversation with you. Appreciate your time. Have a great Labor Day and trading season, investment season for the duration of 2022. And I look forward to us having conversations down the road as well.
Bill, thank you so much for the invitation. And I was thrilled to get the invitation and even more thrilled to connect with you today. And again, it seems like we're on the same page with a lot of things. I don't know if that's good or bad for everybody.
Yeah, don't fade us.
That's right.
Anyway, the best way for people to follow your work, Art, would it be on Twitter or at B. Riley?
Yeah, B Riley website. You can see my contact information on Twitter and LinkedIn. I tend to post everything that I'm either talking about or doing on a daily basis. And once in a while I throw in my 2 interns, which are a couple of King Cavalier Charles, and they've been my steady workmates since the beginning of the pandemic, and are way underpriced.
Art Hogan, thank you. And my trading warrior brother, thank you very much for being with us today.
Thank you.
All right, so that's a wrap, everyone. Hope you enjoyed Art. I did, and remember, don't just count your pips, count your blessings. I'll see everyone tomorrow.